wake up at 5 in the morning, eyes glued to your phone before your feet even touch the floor. Pre-market data floods your screen. You scroll through 15 different charts, check 20 indicators, join 3 Discord servers, watch 2 YouTube videos on double speed, and tweet about your positions before the opening bell even rings. By noon, you've made 7 trades, adjusted your stops 4 times, and completely reversed your market outlook twice. You feel exhausted like you've run a marathon, and you tell yourself you're working harder than everyone else in the game. But here's the brutal truth that nobody wants to hear. You're not making progress. You're just busy. And there's a massive difference between the two that's costing you more money than you can imagine. The traders who actually build wealth, the ones who consistently pull money out of the markets year after year, they're not the busiest people in the room. They're the most strategic. And if you can't tell the difference between motion and momentum, between activity and actual achievement, you're going to spend years spinning your wheels while wondering why your account balance never changes. Let me tell you about Marcus, a trader I met at a conference in Chicago 3 years ago. This guy was the epitome of hustle culture. He traded stocks, options, futures, and crypto simultaneously. He had subscriptions to 11 different trading platforms, paid for 7 alert services, and his office looked like NASA mission control with 6 monitors displaying what seemed like every possible data point in existence. Marcus would tell anyone who listened that he was putting in 80-hour weeks. He'd wake up before the London session opened and wouldn't close his laptop until after the US markets closed. On paper, this guy was doing everything right. Maximum effort, maximum commitment, maximum screen time. But after 2 full years of this relentless schedule, his account was down 32%. Not because he wasn't smart, not because he wasn't dedicated, but because he confused activity with progress. He was so busy trading that he never stopped to ask himself if what he was doing actually worked. The financial markets have a weird way of rewarding you for doing less, not more. This goes against everything we've been taught about success. In most areas of life, more effort equals more results. Study longer, get better grades, work more hours, earn more money, practice more, improve your skills. But trading doesn't follow this formula, and that's why so many people burn out before they ever become profitable. The markets don't care about your effort. They don't award points for hustle. They only care about one thing: were you right about the direction of price movement at the specific moment you entered and exited a position? Everything else is just noise. Think about the most successful investors in history. Warren Buffett spends most of his day reading and thinking. He's made fewer than 20 major investment decisions in his entire career that account for the majority of his wealth. George Soros didn't become a billionaire by making 100 trades a day. He made calculated, high-conviction bets when he identified major market dislocations. Paul Tudor Jones talks about waiting for the perfect pitch, about letting opportunities come to him rather than forcing trades. These people understood something fundamental. In trading and investing, your edge doesn't come from doing more. It comes from doing the right things at the right time. But we live in a culture that glorifies busyness. Social media is full of traders posting screenshots of their watch lists with 40 different tickers highlighted. They share photos of their desks at 3 in the morning with captions about the grind. They brag about how many trades they took that week like it's a badge of honor. And newer traders see this and think, that's what success looks like. I need to be doing that too. So they start mimicking the behavior without understanding that activity is the easiest thing to fake. You can look incredibly busy while accomplishing absolutely nothing. Here's a test that'll reveal whether you're actually making progress or just staying busy. Close your eyes and answer this question honestly. If you removed 90% of the things you do in your trading routine, would your results actually change? For most traders, the answer is no, and that's terrifying. Think about it. All those hours scanning for stocks, all that time reading market commentary from people who are just guessing like everyone else, all those technical indicators you've layered on your charts until you can barely see the price action anymore. If you stripped all of that away and just focused on a handful of high probability setups that you actually understand, would you be worse off? Probably not. You'd probably be significantly better off because you'd eliminate decision fatigue, reduce emotional trading, and actually have time to analyze whether your strategy works. The dirty secret about overtrading is that it's not really about making money. It's about feeling productive. It's about scratching an itch, feeding an addiction to action. When you're in a trade, you feel alive. You feel like a real trader. You're in the game. But when you're sitting on your hands waiting for your setup, you feel like you're missing out. You see other people posting wins, and you think you should be doing something too. So you force trades that don't meet your criteria. You take B-grade setups because you can't stand the feeling of inactivity. And this is where the real damage happens, because every trade you take that's not part of your actual strategy is just a donation to the market. Let's talk about the mathematics of this for a second, because the numbers don't lie. apply. Say you're a day trader and you've developed a strategy that gives you a 60% win rate with a 1.5 to 1 reward risk ratio on your winners. Not amazing, but definitely profitable if you execute it correctly. Now, if you take 10 trades per week using only your A-plus setups, your strategy says you should win about 6 of them. Let's say you risk $100 per trade. You lose $400 on your 4 losers and make $900 on your 6 winners, netting you $500 for the week. That's a 20% return on your risk capital. Pretty solid. But here's what actually happens. You see those 10 setups, you take them, but then you get bored. You see a stock moving and you jump in without your confirmation signals. You revenge trade after a loss. You add 5 more trades that don't fit your plan. Now you're taking 15 trades instead of 10. Those extra 5 trades are random, so they win at about 50% or less, and they don't have the proper reward risk ratio because you didn't wait for the ideal entry. So you win 2 or 3 of those random trades and lose 2 or 3. Best case scenario, you break even on those extra 5 trades. But you probably don't break even because emotional trades usually lose. So now your weekly performance drops from a $500 gain to maybe $200 or $300, and that's if you're lucky. Your return drops from 20% to 6 or 8%, and all because you couldn't sit still. You turned a winning week into a mediocre week just by being too active. Now multiply that across a year. 52 weeks of giving back 20 to 30% of your edge because you can't tell the difference between trading your plan and just trading. That's the difference between making $26,000 in a year versus making $10,000 or $12,000. Same strategy, same skill level, but wildly different results just based on discipline and understanding what actually creates progress. The concept of opportunity cost is something most traders completely ignore. Every time you take a trade, you're using up finite resources. You're using mental energy, emotional bandwidth, and actual capital. If you blow through your daily loss limit on 3 garbage trades in the first hour of the market, you're not available when your actual setup appears at 2 in the afternoon. If you tie up all your buying power in 5 mediocre positions, you can't take the one perfect setup that might make your whole week. Activity doesn't just fail to create progress, it actively prevents progress by consuming the resources you need for the trades that actually matter. There's also the psychological damage that comes from overtrading. Every loss hurts a little bit, even when it's part of your plan. Your brain doesn't distinguish between a planned loss and a stupid loss in terms of emotional impact. So when you're taking 15 losses a week instead of the 5 that your strategy expects, you're subjecting yourself to triple the psychological wear and tear. This leads to decision fatigue, increased stress, and eventually to the emotional spiral where you start making even worse decisions because your mental state is compromised. The traders who last in this business, who build sustainable careers, they understand that preserving psychological capital is just as important as preserving financial capital. So what does real progress actually look like? It's quiet, it's boring, it's uncomfortable because it doesn't feel like you're doing enough. Real progress is trading less and analyzing more. It's keeping a detailed journal and actually reviewing it to find patterns in what works and what doesn't. It's having the patience to wait hours or even days for your setup instead of forcing something to happen. Real progress is saying no to 95% of the opportunities the market presents because they don't fit your criteria. Real progress is accepting that some days you won't trade at all and being completely okay with that. I know a trader named Jennifer who made this shift about 5 years ago. She started her career as a hyperactive day trader, taking 30 to 40 trades a day, convinced that volume was the path to wealth. She stayed busy, she felt productive, but her account barely moved. Some months up, some months down, mostly just chopping around break even after commissions. Then she had a realization after reading her trading journal from an entire year. Out of over 6,000 trades she had taken, fewer than 200 of them accounted for all of her profits. The other 5,800 trades were essentially noise, random outcomes that canceled each other out but cost her a fortune in commissions and emotional energy. So she made a radical change. She decided to only trade one setup, one specific pattern that showed up maybe twice a week if she was lucky. Everything else, no matter how tempting, she ignored. The first month was torture for her. She felt lazy. She felt like she wasn't really trading, but her account went up 8%. The second month, same thing, up 11%. By the end of the year, she had her best performance ever, up 73%, while taking fewer than 100 trades total. She went from 6,000 trades a year to less than 100, and her results improved by a factor of 10. That's not a typo. She traded 98% less and made 10 times more money. That's the power of understanding the difference between activity and progress. The markets reward precision, not volume. They reward patience, not speed. They reward correct analysis, not constant analysis. You don't get bonus points for watching charts 16 hours a day. You don't get extra returns for checking your positions every 5 minutes. In fact, studies have shown that investors who check their portfolios less frequently actually outperform those who monitor them constantly because they're less likely to make emotional decisions based on short-term noise. Here's another uncomfortable truth. Most of the educational content in the trading world encourages activity over progress because activity is easier to teach and easier to sell. A course on 50 different indicators and 10 different strategies sounds way more valuable than a course that teaches you one simple approach and tells you to wait patiently for it to appear. Complexity sells. Simplicity doesn't. So you get bombarded with information about exotic option strategies, advanced technical patterns, obscure indicators that promise to predict market moves, all of which just adds to your sense that you should be doing more. The industry profits when you're active because every trade generates commissions, spreads, fees. A trader who takes 100 trades a month is worth more to a broker than a trader who takes 5, even if the second trader is more profitable. This is why you need to be ruthlessly honest with yourself about what's actually moving the needle in your trading. Keep a detailed performance log that tracks not just wins and losses, but the context around each trade. Was it part of your plan or impulsive? What was your emotional state? How long did you wait for your setup? Then, after a month or a quarter, analyze that data like your financial life depends on it, because it does. You'll probably find that a small percentage of your behaviors drive a large percentage of your results, and the rest is just activity that makes you feel busy but doesn't create progress. The concept of keystone habits is useful here. A keystone habit is one behavior that naturally leads to other positive behaviors. In trading, one of the most powerful keystone habits is simply waiting for your setup. When you commit to only taking trades that meet your predefined criteria, a cascade of positive effects follows. You automatically reduce overtrading. You improve your win rate because you're being selective. You decrease emotional decision-making because you're following a process. You preserve capital for the trades that matter. You reduce stress and decision fatigue, all from one habit, patience. But patience is hard because it requires you to do nothing, and doing nothing feels wrong in a world that celebrates hustle. You have to retrain your brain to understand that in trading, doing nothing is often doing something very valuable. You're preserving resources, waiting for an edge, avoiding mistakes. The best trade you make this month might be the one you didn't take, but you'll never get credit for it. Nobody posts screenshots of the trades they passed on. Nobody brags about the day they sat on their hands even though it saved them from a $2,000 loss. The wins that come from discipline and patience are invisible, which makes them easy to undervalue. Let's address the fear that drives a lot of this activity. The fear of missing out is incredibly powerful in trading. You see a stock running, you see people posting profits, and your brain screams at you to get involved. But here's the reality. You're always missing out on something. Right now, at this very moment, there are thousands of stocks moving, hundreds of opportunities in different markets around the world. You couldn't possibly take all of them even if you tried. Missing out is not a bug. It's a feature of trading. The question isn't how to avoid missing out. It's how to make sure that when you do take action, it's high-quality action with an actual edge. Professional poker players understand this concept deeply. They fold the vast majority of hands they're dealt. They're not playing to play. They're playing to win, and winning means only getting involved when the odds are in their favor. A professional poker player might fold 30 hands in a row and feel completely fine about it because they know they're waiting for the situation where they have an advantage. Trading should work the same way, but most retail traders treat it like they have to play every hand just to stay in the game. The transformation from activity to progress requires a fundamental shift in how you measure success. If you currently measure success by how many trades you took, how many hours you worked, how many charts you analyzed, you need to change your metrics. Start measuring success by how well you followed your plan. Track your A-plus setup win rate separately from your overall win rate. Measure how often you avoided taking a trade that would have been a loss. Calculate your profit per trade, not just total profit. These metrics will tell you whether you're actually getting better or just staying busy. You also need to build systems that protect you from yourself. Remove the temptation to overtrade by setting hard rules. Maybe you only allow yourself 3 trades per day maximum. Maybe you only trade the first 2 hours of the market session. Maybe you require yourself to wait 30 minutes after seeing a potential setup before entering, just to make sure it's not an impulsive decision. These constraints feel restrictive, but they're liberating because they remove the constant mental burden of deciding whether to trade or not. The decision is already made by your rules. Another powerful technique is to track your state of mind before each trade. Are you calm and confident because you've identified your setup, or are you anxious and uncertain because you feel like you should be doing something? That emotional check-in can be the difference between a high-quality trade and a mistake. If you're entering a trade because you're bored, frustrated, frustrated, or trying to make back a loss, that's activity. If you're entering because your specific criteria are met and you've done your analysis, that's progress. The bottom line is this: the market doesn't care about your effort. It doesn't reward you for hours worked or charts analyzed or videos watched. It only rewards correct decisions at the right moments. And those moments are rare. They don't happen every day or even every week sometimes. Your job is not to force those moments to appear. Your job is to be ready when they do appear and to preserve your capital and psychology in between. That's progress. Everything else is just activity. And activity without progress is just expensive motion that drains your account and your soul. So ask yourself right now, honestly, are you confusing activity with progress? Are you measuring your trading by how busy you feel or by whether your account is actually growing? Are you taking trades because they fit your plan or because you can't stand sitting on the sidelines? The traders who answer these questions honestly and make the necessary changes, they're the ones who are still around 5 years from now. The ones who keep confusing motion with momentum, they burn out, blow up, or quit, wondering why their hard work never paid off. Don't be that person. Trade less, think more, and watch your progress finally match your effort.